Yes. So once again, very, very happy good morning to all of you. Thank you so much for joining today's session, which is on sustainability related ESG derivatives. And as many of you know, this is part of our webinar series, deep dives with IIQF experts. And in this webinar series or webinars rather, we take upon important topics related to our field of quantitative finance or financial engineering, risk management, algorithmic trading, uh, derivative valuation pricing, risk, and of course, applications of data science, machine learning in different areas of finance, right? And we are extremely happy to have with us Sanjay Bhatia, who will be presenting today's topic. Thank you so much, Sanjay, for joining in. Just to briefly introduce,
Yeah, thanks, Nitish. Thanks. Hopefully, I'm audible.
yes, we can hear you. We can hear you. All right. So, briefly to introduce Sanjay. Sanjay has done his MBA and MSc. MSc was in machine learning and AI from Liverpool John Moores University. He also has a PG diploma in machine learning and AI from Triple IT Bangalore. Sanjay has been a risk management and analytics professional with more than 16 plus years of mainstay experience in risk models and methodology space, encompassing various areas, Basel, Advanced AIRB, IFRS 9, IMM, SSCR, Exposure, XVA, FRTB, OTC derivative, valuation and pricing, and other related modeling topics. And he has been working in the combined field of ML and risk management also for the last few years, right? He has previously worked with various foreign banks, Barclays, RBS, Citi, Credit Suisse, UBS, primarily in the risk consulting domain. He is also very passionate about imparting practical model understanding and insights and has been a professional trainer for corporate and investment banks. Sanjay has been one of the lead faculties at IIQF as well. His areas of interest are credit and counterparty credit risk, market risk, stress testing, stochastic modeling, quantitative finance, and machine learning, right? So, Sanjay, once you are ready, I'll hand over the session to you. But before that, maybe a quick glance of like how we would go forward in the session. So, as you all know, the session would be for about 1 hour and followed by the Q&A session. And during the session or post the session, please feel free to type in your questions in the question chat box. uh, we would be happy to take up all questions, as I mentioned earlier as well. So we want the session to be very interactive. So please keep the questions flowing. And unfortunately, since there are a lot of participants, so we are not able to allow you to speak up. Nonetheless, you all can post your questions in the chat window and post the session. We have a specific time allocated for the Q&A, and we'll take up the questions. All right. Okay. So with that, I'll hand over the session to Sanjay. Sanjay, just give me a moment. I'll make you the presenter as well. Did you get the presenter right? Yeah, now you'll be getting. You are on mute, Sanjay. Please unmute yourself. Sanjay, you are on mute.
Yep. Got it. Maybe. Yeah, I was just trying to share first, but maybe a warm welcome to everyone. And maybe so we have had always an effort or endeavor to bring up those topics which are going to disrupt the future course of finance, and how the investments, capital, as well as the money has been channelized and targeted to specific areas. So we would be clearly seeing some patterns which we have already been seeing in last few years, where uh, very intentionally the regulatory bodies, the super regulators, as well as the government and non-profit organizations are pushing this agenda forward to do sustainable finance. And what that constitutes is not only in the private markets, like lending markets, but also in the public markets, in the public market space or capital markets. There's a push to channelize the money investments to those particular sectors which have better ESG score. So we would be talking about the role of derivatives, and what kind of different derivative products, instruments, transactions which have come to our fold, and maybe are unfolding in this space to help investors to to do that particular transition of channelizing their investments from high carbon footprinting sectors, industries, regions, areas, to low carbon footprinting sectors, industries, regions, areas. So that would be our topic, and how, why you should be aware, and what is happening, and why maybe as somebody who is aware about climate risk modeling, sustainability finance, sustainable investments, uh, green bonds, or maybe carbon trading, or all these topics, right? This is going to determine the future course of action by many financial institutions. And also this would be a space which we would see that over the last maybe 5 6 years have grown massively, right, with intervention from regulatory bodies and policy setters. And it's going to grow more with the adoption being very mandated for major financial institutions, or specifically globally systematically important banks and financial institutions. So that's why, as the efforts and the maybe imposition of rules, regulations, policy framework is growing, so is the bank is forced or compelled to build up such capability, modeling, quantitative capability in the area, specifically how to, the product specialist of such sustainability related derivatives, the pricing experts who could price or do valuation of such derivatives, the policy experts who could maybe align with the policy of European Banking Authority, or maybe European Commission, or maybe other regional bodies, specifically the International Protocol on Climate Change, which was signed in Paris. So all these kind of thing, maybe we which require a huge amount of workforce demand, employability standpoint, that maybe we need such resources who are well versed with the topic or subject, and are have hold a certain degree of expertise to take the agenda forward. So with that context, I think maybe it paves a way for you to learn, also to deep dive into this particular topic, which anyway is also our personal responsibility, because we are living in this planet, and it's our responsibility to maybe protect this planet as well, right? So it is not only doing maybe just monetary or a career oriented favor, but also a personal favor to yourself as well, right? So uh, climate risk, if I were to sum up, uh, you know Paul Hawking once said that at present what we are doing, we are stealing the future, selling it in present, and calling it gross domestic product. So whatever industrialization driven gross domestic product or gross value added kind of uh, economic setting which we are in, that is stealing our future and selling it to the present, right? So he very eloquently put this. And before we deep dive into some of the derivatives, like sustainability linked derivatives, or maybe ESG related credit derivatives, or ESG related exchange traded derivatives, or emission trading, these are broader categories of derivatives which have come to the market, right? Before we deep dive into those, the kind of characteristics of those particular products and transactions related to each of those particular ESG related derivative classes, we will just have a framework level understanding of how the ESG modeling framework or quantitative framework, or maybe a framework measurement framework works, right? So basically, when it comes to ESG, we call it environmental, social, and governance related factors. But the main predominant focus would be on environmental. The social and the corporate governance factors are basically institutionally led, and maybe those are some of the institution which maybe help those are some of the requirements which help how an institution, what they are doing for the community under social, and what they are doing for maybe from a governance standpoint, like Sarbanes-Oxley Act or some of those acts which make them responsible for, from a governance standpoint, and they hold accountability on and responsibility while being a profit making institution. They are still responsible and accountable. So the social and governance part being maybe part of the overall scorecard, but majorly, predominantly, the focus is of climate risk modeling or sustainability finances on environmental, right? Under the guise of the environmental, we have broadly two kind of risk. One is physical risk, and the second one is transition risk. The physical risk relate to maybe any direct vulnerabilities, any direct harm to the assets, or any disruptions in major supply chains, the broader sectors, industries, the major value chains. Like if something is happening to transport and logistics, right? Due to climate risk vulnerabilities, if something is happening to industrials, if something is happening to maybe the shipping industry, right? So the entire, or maybe the if something is happening to the traditional or conventional energy producers, right, producer market, right, then the whole economy or the global economy could be disrupted. So those are basically physical or direct risk to the assets, to different capacities in those particular area which make the global supply chain work, right, at a country level, at a global level, right? Transition risk. Transition risk is basically that eventually, even if not, some of these physical risks hold low probability of happening in the immediate future. By immediate future, I mean like next 5-10 years, they still have reasonably relatively low probability of happening. But we won't be sitting and waiting for that to happen, because we for sure know that maybe we are moving in a direction where oceans are boiling above 2 degrees Celsius, and maybe icebergs are melting, and maybe some of the land mass is submerging under the water, right? Some of the due to deforestation, many of the green cover is going, it is reducing the habitat. It is creating maybe disruption in the food value chain or food supply chain. A lot of these things are already happening. So we won't be sitting, we won't be waiting for the event to happen. So the transition risk is where there are certain goals and objectives which are signed into a pact, like international Paris International Protocol on Climate Change, which various countries, various governments, various sovereigns, various non-profit organization, various corporates have signed up to, right? And they have to now, after signing the pact as part of the agreement, they have to comply to enforce a transition, a time bound transition. By 2030 they will have some target of maybe reducing the carbon footprints by a certain amount, right? Or carbon emissions by a certain amount, or similarly by 2035, 2040, and 2050. So you will see a lot of these particular targets at a country level, and the country could maybe define these targets at a province or state level or county level, so on and so forth. And then maybe that could be enforced at a maybe legal entity level or corporate level, right? Wherever a particular corporate is incorporated under whichever jurisdiction. So this will happen, and once it is you know taken a legal you know uh, stature, like then it becomes a legal risk for or reputational risk for the corporate as well, if they would want follow those particular targets, right? So transition risk is basically how we are transitioning from a high carbon economy to a low carbon economy, and it includes a lot of maybe disruptions by maybe this transitioning, like as you move away from your dependency on fossil fuel to renewable energy, there would be a cost implication of on you, there would be a business implication on you, there would be a profitability implication on you, right? And all of that need to be baked in, right? So what is the transition risk and the cost, related cost and implication? So that is the second aspect. These are two broader facets. So just breaking down climate physical risk is, maybe it is basically monitoring the weather patterns, the climate changes, right? And it is like you calculate value at risk, right, or earning at risk. Now under the climate risk modeling, you would be calculating specifically for physical risk, asset at risk, asset value at risk, asset valuation at risk. So it depends upon multiple factors. What is the location of the asset, what is the build quality, materials, what is the structural strengths and individual component cost, right? And generally maybe there are third party vendors which provide this particular data, like what which are the maybe specific vulnerable regions, vulnerable sectors, vulnerable industries, vulnerable segments, right? Where such particular physical risk is very high, like a coastal area, or maybe a travel and tour operator or a hotelier working very much in Mauritius is at a high risk, because Mauritius is maybe the landmass is going underwater, right? So some of these coastal belts where you have hospitality and tourism kind of business operators, they are at high, they are flagged at high risk, their asset valuation are flagged at high risk. So those banks or financial institution who have lent a capex, a capital expenditure kind of a loan or financing, or a operating expenditure kind of a loan or financing to these kind of uh, you know uh, businesses or corporate institutions, would have to do something about it, because maybe what they did is they gave that particular loan or financing or funding, and they took that particular asset as collateral, but that asset valuation is at risk, right? So that is broadly what climate physical risk means. Climate transition risk means that certain, as I said, certain no tolerance policies, no tolerance regulation or rules, right? Net zero policies, carbon taxes which would be imposed. So if it's not just maybe you doing nothing would maybe, or you procrastinating or delaying your carbon targets uh, would not invite any implications. It would the government can anytime levy a carbon tax on you, a new form of taxation, which will penalize those particular companies who are not uh, budging up, right? So uh, and also the transition risk is also about a lot about, right, the change in the modes and means of transportation, like move to the electric vehicles or like electric mode of transportation. Like what will happen to these various petrol pumps or petrol stations, and the oil and gas distribution companies, right? What will happen to their valuation, or once their business model is getting transition, and we will see more and more elect, electric stations, right, coming up, and more electric infrastructure coming up, right? So it also include, as part of the overall ESG, a kind of sentiment changes, like when these things awareness will grow, then maybe a lot of social pressures will also come. There would be protest, there would be some kind of non-profit related activities, led activities, which will further disrupt and maybe create reputational risk, or some kind of a social and governance risk for banks, for corporates, when they are not living up to the ESG standards, right? And also consumer market changes, right? Some of the consumers who are well aware have stopped consuming those kind of products, services, solutions which are based on a high fossil and fuel kind of inputs, right? So what are the climate physical hazards? Some of these physical hazards could be, right, and the frequency and the severity, loss severity and the loss frequency could vary, but these events would be riverine flooding, surface flooding, right, maybe due to heavy precipitation or excessive rainfall or snowing, or maybe excessive ice, right, high wind speeds, hurricanes, cyclones, thunderstorms, high temperature heat waves, fire risk like what you saw in New Zealand and Australia in recent times, freeze thaws impact. So all these kind of things are actually physical risk which could impact your asset valuation. And there are certain, these are acute physical risk which will keep happening from time to time, but there are chronic physical risk which will still be slowly and gradually happening anyway, which are going unnoticed, like sea level rising, right? Okay, due to maybe the high temperatures, sea level rising, high variability in precipitation, they keep on creating long term effects, while some of the short term and medium term effects are created by acute physical risk factors, right? So so what we mean is that we need to do some catastrophic or weather modeling or some kind of a event modeling for predicting the physical risk, right? What is the probability of these acute physical risk? What is the probability of, in the short term and medium term, what is the probability of acute physical risk? And in the long term and in the long run, what is the probability of chronic physical risk, right? We need to also capture the exposure, right, to short term and medium term acute factors, acute physical factors, right? And maybe uh, bake in what is the probability and severity of those particular losses which could happen due to these acute physical risk factors. Like for example, I could say, right, that maybe these risk factors, right, like riverine flooding or surface flooding or maybe wind speed related hurricane or cyclone, these would have different probabilities of happening both in short term as well as in medium term, right? I could take a probability weighted exposure, right, combining all these factors based on their probability. So it would include that what is my loss severity when a riverine flooding would happen, what is my probability of that particular event, riverine flooding happening? So probability multiplied by the loss, right? Similarly, probability multiplied by the loss for surface flooding, probability multiplied by the loss of wind speed related acute physical risk. Similarly, high temperature and heat waves related acute physical risk. So each of the probability of each of these particular events, right, on a short time frame and a medium time frame, multiplied by the respective loss severity, will give us maybe an idea what is the loss happening, and based on that we need to buffer up our capital, we need to buffer up our reserves, surpluses, provisions to weather the storm, right, literally, right? So that's what maybe it would entail. But now majorly this was a broader kind of overarching framework within which the modeling is operating. Many of these models focus on physical uh, acute risk, as well as the physical chronic risk, as well as the third category would be the transition risk, right? And with these with the transition risk is a bit of qualitative scorecard as well, because once the things transition from the high carbon economy to a low carbon footprint economy, right, some of these things would also not become remain environmental. As I told you that it would have impact on your social score, it would have impact on your governance score. So the entire ESG scorecard will move up and down based on how e- environmentally you are compliant, how sustainably you are compliant with the with the standard, right? Now, the other idea is the basic idea behind derivatives initially, when derivatives were first introduced, was not for for investors to find a way to take a leverage exposure to certain asset class which they could not. Leverage exposure here means like with putting less of the margin money, very little margin money, you could take a huge exposure to an asset class, which if you, I would ask you to buy a equity stock or equity, index, you would be required to pay that money upfront. By through derivative, you are, you know taking, paying very less upfront and taking a huge bulk leverage position. So the derivative nowadays is used to take leverage heavy positions and or for all speculative trading purposes, but originally that was not the intent. The original intent of derivative when it was first introduced, one of the first derivative which came in 18th century were weather derivatives, was to do the price discovery mechanism, because some of the events, right, and their frequencies are very less and very not observed on a daily basis. So how to price for those particular events or risk, right? Okay, so that was the price discovery mechanism, was the first objective or intent of introducing derivatives. uh, then the second, bona fide use was hedging, right? Thereafter came maybe uh, the use of it for taking leverage position or trading, or even doing speculative, taking speculative position, or even for doing arbitrage. Those are some of the pure trading aspects or use cases of derivative. But initially the derivatives, from a very uh, you know end use perspective, was introduced to do price discovery, was introduced to do hedging. Now the same is what we are seeing in this new topic called ESG, right? And specifically environmental, right? Let's confine to environmental, because environmental would eventually, due to the transition risk would create some kind of effect on your social and governance scorecards, right? Now what is so basically there are certain derivatives in order to promote sustainability finance, sustainability investment, sustainability driven capital flows. There are certain derivative products, derivative transactions, derivative instruments which are being introduced, and we need to put efforts to understand, right, what those derivative instruments are all about. The first of them, and this is borrowed from an ISDA paper, you could read that paper, you could find the link below, you could, in the footnote, you could read that paper. That is very interesting paper that has become almost a market standard now. So so you could read that particular paper, right? International Swap and Derivative Association has uh, introduce a paper which talks about these sustainability related derivatives, and the link to that is given. But you know broadly, the first uh, kind of product, you call it derivative, the sustainability linked derivative product is called the sustainability linked derivatives. Now these kind of derivatives are not very different from our existing derivatives, like interest rate swaps, cross currency swaps, or forward rate agreements. These are not very different, but there are certain aspects which are embedded, which are related to ESG, specifically environmental, right? So there's certain environmental related aspects embedded into those particular derivatives, and we started calling them sustainability linked derivatives. So these are an extension of our existing derivatives, the features they have, broader product features they have, and with a sustainability dimension to it, right? So what kind of those kind of dimensional characteristics these sustainability linked derivatives hold? The first being that maybe such derivatives, under such derivatives, right, if you are a maybe buyer or holder of such derivatives, the counterparties either receives or pays, right, based on whether it achieves or fail to achieve some predetermined ESG or sustainability performance target. So there's a ESG or sustainability performance target which is set as part of the derivative contract, right? Uh, and if the counterparty either achieves that, overachieves that, or underachieves that, or completely drastically fails to achieve that, there's certain kind of incentive structure, certain kind of uh, you know either the counterparty receives payments based on its achievement, or the counterparty, the related counterparty or the underlying reference entity pays, right? Okay, so and this is one aspect of feature of sustainability linked derivatives. The second aspect is either, so in this case what is happening, the first feature allows the counterparty to gain by following certain sustainability performance targets, but the second aspect allows counterparty to contribute, not only just gain, right, to contribute, right, not only to just boost its profitability but to contribute, right. Counterparty in that case would also gain because there are certain tax incentives, there are certain tax breaks, there are certain other incentives, subsidies being given by the government, right, if they contribute, right, to such causes or to such projects. So the other aspects is that the based on certain, the derivative could include certain features where if the counterparty fails, then it has to pay or contribute certain amount to a non-profit sustainability project if it achieves the sustainability goals or target. Then the bank or the seller would pay the counterparty, sorry, the seller would pay to that particular a non-profit sustainability project. So there's a third party involved, that non-profitability sustainability project or a fund, to which the two parties, the derivative seller or the buyer, will contribute to based on certain ESG sustainability goals. If it is met, then the the seller would pay. If it is, because seller is earning some kind of a premium on that derivative, right? If it is not met, then the buyer would pay, right? So these are basically how the channelization of finance is happening to specific projects, or those kind of projects which are into sustainable development or sustainability or renewable energy or whatever, right? So let's take an example, right, of these kind of transaction characteristics or product characteristics. So a swap derivative, right, uh, you know can have a positive or negative spreads to a fixed rate, right? So a swap is basically where you are exchanging two legs, right? Like you are exchanging under an interest rate swap, you might be exchanging floating to fixed, right? Okay, so the fixed leg, could have, the fixed leg is based on certain benchmark rate plus certain spread. So that spread, right, uh, which is uh, you know set maybe above the benchmark, could be maybe at the inception could be set either positively or negatively, right? And there's a scorecard, there's a third party valuation company which is called Sustain Analytics, right, which do this kind of a pricing, what would be the spread which need to be added, whether it's positive or negative, to how much, to what extent, what basis need to be added. So at the beginning of each year, once this swap is maybe you know um, uh, you know uh, bilaterally traded, at the beginning of each year, if the counterparty achieve the ESG score or rating, right, a discount of 5 to 10 basis point would be applied to this fixed rate, right, which will benefit the counterparty in reducing their cost of financing. Otherwise the counterparty will pay, you know 5-10 basis point extra over the fixed rate, right, which means that its cost of financing will increase. So it's similar to like saying that, okay, you are a bad guy, on your ESG score, so I'll penalize you by charging you more premium or more interest or higher interest, right? And that is, if you're a good guy, right, who is very well compliant with its ESG score and holds a better score, and the score is improving, year by year, then your cost of, or your interest cost or your financing cost would get reduced, because you will each time get a 5 to 10 basis point discount on the fixed rate which you have been paying under the swap contract. So this is the first, where now this links to my first characteristics, this first characteristics of this particular feature, that where we are directly providing that benefit to the counterparty, right? The second aspect being that, uh, instead of doing this, involve a third fund, or maybe kind of a sort of a vehicle, special purpose vehicle, or a fund, which is pooling the money for investment into projects which are environmentally or sustainability driven projects, right? So we have either, maybe most of these banks have, launched a fund, right? Most of the big Wall Street banks and big London Street banks and whatever have launched big sustainability funds, and you would be required to contribute to that sustainability fund, do some charitable donation if your ESG score or rating deteriorates, right? Okay, so the if the counterparty ESG score or rating maybe changes, then they will be prompted to do some charitable contributions, right? If it want changes, then the writer or the dealer or the seller will donate to that sustainability funds, right? Okay, so this kind of incentive structure or economic structure also is promoting that you, out of your profit, you have to contribute something to that particular fund or SPV, which further invest in such kind of renewable or sustainability led projects. And that kind of, it keep off buffering, because either, like, this is a derivative, either you win or I win, right? So either of us would be contributing something to that particular sustainability fund. Yeah, so that's about sustainability linked derivatives, what kind of uh, features are baked into them, or muster rolled into them to make them a bit of ESG driven. And now these form prominent parts of the private lending markets. Many banks like uh, ING Vysya, and uh, HSBC, Santander, right, have done their very recent transactions, huge transactions, like maybe 200 million of loan, 300 million of syndicate loan, right? Baking these kind of things like swaps into their transactions, so that maybe that kind of loan financing, loan maybe the pricing will be decided based on maybe certain swap, uh, you know which will enforce that kind of sustainability financing to those particular counterparties, right? So there have been recent big transactions which happening, and this sustainability linked derivatives form the first nascent initiative, right, for channelization of majorly in private credit markets, where lending markets, where banks are lending huge money to corporates, right, or these industrial concerns, how to impact or disrupt that financing, how to make banks to lend more to the uh, those particular sectors which are carbon low footprint, and less to the those particular sectors, or you know on unfavorable terms to those particular sectors which have high carbon footprint, high carbon emission, right? So that's the intent here, right? Now, the coming to the second derivative, which is the credit related derivative, CDS contracts, right? ESG related CDS contracts. Now you understand the CDS, credit default swaps, right? You understand the credit default swaps, uh, right? So the previous one on this, while we were here, was a bit like maybe your interest rate swap, right, with the baked in feature of, you know ESG, right? Environmental or sustainability kind of financing, or maybe certain conditions related to environmental and sustainability. That derivative, this derivative achieves its value, and it would be in the money only based on certain event which is related to the sustainability risk or sustainability vulnerabilities, right? This kind of derivative, the second derivative, is more of a credit derivative. It allows a lot of things. It allows you to hedge, it allows you to speculate, it allows you to take a view on those particular counterparties which are maybe like if you want to short sell, right, certain counterparties which are in broadly in those particular sectors, industries, regions which are very much vulnerable, right, which have huge climate risk or climate vulnerabilities. You could use these CDS contracts to take a short position, take a short position, or these CDS contracts to take a long position on those counterparties which are in renewable sectors, which are in sustainability driven sectors or investments, or maybe those kind of new kind of uh, modern transition kind of business models, right? So the if some of the firms or corporates are into creating maybe those logistics or mobility solutions where which are purely you know electric based, right, then basically how to take exposure to such names, right, or how not to take exposure to some names which are heavily polluting or using fossil fuels to do shipment and transport, right, how to move. So being an investor in the market, you don't are you know you are just an equity investor, right, but how to, or bond investor, but how through the use of derivative you too could take a position into those kind of companies which are maybe driven by sustainability or not driven by sustainability. That's the idea, right? So this kind of a what kind of risk characteristics this kind of derivative holds is uh, you know it allows market participants to manage the credit. The third aspect is it allows hedging as well, right? If you have already been exposed to some counterparties who are maybe to whom you have done financing, lending, whatever, you need to buy a CDS to hedge that particular millions and billions of exposure to those kind of counterparties. So sometimes uh, some loans, some of these big ticket size loans to industrial concerns and large corporates are run into years. Like I have given a loan for 15-year, 20-year, right? Or even to sovereign, some of the local authorities, municipalities, or governments, I also give loans which are more than 30 years. Now, in next 5 years, if even if I am assuming nothing would happen, no acute physical risk, no transition risk, nothing that sort which could impact that particular counterparty, but definitely in medium to long term there's a risk, right? How I could ensure that my risks are covered when I'm holding such held till maturity long position to a counterparty which is very bulky? I need to buy a CDS contract, and that avenue, the CDS contract, previously CDS contract was only linked to credit performance of the counterparty, or the credit rating or the credit scoring of the counterparty. Now, this kind of CDS contract linked to the ESG scorecard or ESG rating of the counterparty. So what it does is it allows the market participant to manage their credit risk on their books, right, towards a counterparty. Uh, when they see that the counterparty financial results or financial performance might suffer due to climate change or such kind of vulnerabilities or viabilities, or maybe such kind of things are viable, or maybe the counterparty is vulnerable, right? uh, Now ESG, there's a parallel set of third party vendors or maybe ESG solution providers, products or services, which are doing the ESG research as well, which suggest that the counterparties with low ESG score would have poor credit rating or poor credit performance or financial performance, right? That is called ESG screening, right? And those kind of uh, things are, so what how they screen, right? The wherever based on correlation simply, right? Screening means based on correlation. If I would say, right, I need not to do anything, that the ESG score of the counterparty is highly correlated to the credit score or the of the counterparty. There's a high significant correlation. So I'll, screen all those companies with such high correlation. What it means is, by screening means is, I'll get that kind of sample, right, from the entire population, where maybe the financial performance is heavily dependent upon the environment or climate sustainability, right? If the environment or climate sustainability won't be there, the financial performance, business risk, right, financial risk will increase, right? So I could simply from my rating model apply a screening wherever the financial scorecard or financial rating has hold high correlation with ESG scorecard or ESG rating. I could screen all those companies, and as a market maker, in investment banking we call it market makers, who write those kind of products, those kind of derivatives which have not been written, right? Right, so I can write such derivatives, right, CDS derivatives on those screened names, right, or on those reference names which have high correlation between their financial scorecard or financial rating and the the ESG scorecard or is ESG rating, right? So by being a seller, I know that such demand is there. That's why I'm screening those companies and playing the role of a seller or writer. I'm writing the CDS contracts on those, because maybe I see that a lot of banks, financial institutions, maybe fintech companies have exposure to such firms, and they would like to hedge. They would like my product, my CDS derivative, to hedge, and I would be earning a lot of premium. That's why I'm selling, right? So this is the sell side, right, where I would participate in the market by selling or writing such derivatives, but only after knowing which particular names and reference names to write on, which comes from the screening, right? Okay, right. So okay, and the other research suggests that maybe the those companies which have good ESG score, right, uh, offer higher returns. Now this is another type of screening. If you are a fund manager, if you are an investment manager, if you are portfolio manager, if you are holding a fund, mutual fund, endowment fund, maybe uh, pension fund, insurance fund, right, all these, even hedge fund, all these kind of different kind of funds, investment funds, uh, if you are a fund manager, you would also like to screening, right, for your investment, like where to invest, which companies to invest. So there the screening means are slightly different than what it meant for you know a credit portfolio versus an equity portfolio. In equity portfolio, the screening means this, that you will see, right, where the returns are highly correlated, the risk adjusted returns are highly correlated with the ESG score, right? ESG score or ESG rating. Wherever the risk adjusted return are highly correlated with the ESG matrix, you will screen those companies and, right, you will take positions, either short positions or long position, depending upon whether it's a positive correlation, it's a, or negative correlation, right? Okay, positive correlation means that if ESG uh, the the climate risk will increase, right, your returns will increase, right? Or if climate risk will decrease, your return will decrease. So that those kind of companies you will invest in, right, you will take a buy position or long position. The other aspect is where the climate risk will you know the screening is that the negative correlation is the where the climate risk will increase and your company returns, risk adjusted returns will decrease, right? Or the other way around, the climate risk will decrease and the company returns will increase, right? So those kind of uh, you know things you will take a sell position, right? You will take a sell position in your portfolio. So such kind of screening is part of equity research. Such kind of screening is part of credit research or fixed income research. And once the screening happens, and such kind of screening is also part of market making activities, where certain broker dealer institutions, right, certain underwriters, certain market makers are trying to come up with new products, new derivatives to sell in the market or trade in the new products or new derivatives, right? So these kind of screening will be performed at different level to see what kind of instruments or what kind of products or what kind of companies or what kind of uh, target companies or target investments will come out, right, for each of different kind of portfolio, right? So and in nutshell, what we can say, a CDS ESG related credit derivative or CDS contract, right, is just like a credit insurance which allows hedge against the future potential losses, right, due to catastrophic events or climate events. And specifically those catastrophic events, not all catastrophic events, like I won't say, maybe if wind start, like winds still, if maybe something will happen, if it won't create a bankruptcy or default, then it is not. So those climate events, those catastrophic events which create bankruptcy, which create defaults, which create insolvencies, right, which create bankruptcy, which create defaults, which create insolvencies, like a fire, a forest fire or a fire, raging fire, right, it could burn your mortgages, right, on in your home loan portfolio or mortgage portfolio. It could burn down the entire city, the entire towns, right? It could create, a space where which is non-livable, where even if that is not burnt, but in and around there's a smoke, there are ashes, people will migrate from that particular region to some other region, and the houses prices or house price index tank down, right? If you have a mortgage portfolio, if you have taken those kind of properties, right, most of the borrowers on those particular properties will default because their values will nosedive, and you would be left with nothing. You would not even have any value uh, to realize after selling those particular mortgages or collaterals, right? So those kind of thing, right, wherever any catastrophic event or climate risk event could create bankruptcies, insolvencies, or maybe some kind of a defaults, it would be covered. That kind of risk would be covered for people to hedge under this CDS, right? uh, the other part is, right, it allows investors, and market participants to uh, you know hedge the risk, you know due to changes in the market value, right, of certain bonds, of certain loans, uh, because of the losses due to these factors, right? Okay, so the market also, right, like a bond floated by Shell, right, or uh, right, today maybe could pose a risk because that bond uh, price could suffer, right, because it is into fossil fuels, right? How to allow a hedging instrument to investors, to those particular investors who have invested heavily in British Petroleum, Shell, maybe some of these oil producers, or is even some of the highly pollutant maybe you know uh, names across sectors, industries, region, right? Okay, so in recent times, in May 2020, IHC market, right, has launched a index called iTrax MSCI ESG screened Europe index. I told you what ESG screening means, right? ESG screening means which names will form part of that particular index, and the index is being launched by IHC market, iTrax MSCI ESG screened Europe index. This include European companies, right? So this is a broadly Europe corporates CDS index, which has screening based criteria to pick up those companies based on their ESG scores, right? Okay, right. Across different sectors, across different topics, across different ESG topics, across different criterias, right? So this particular, maybe they have done some screening based to to take a decision which particular companies or names would be part of the index. Now, what is the benefit of index? A CDS, when generally, like I would say, I would write a CDS on you, right? I would write a CDS on someone, right? Unless it is listed on an exchange, it would be a OTC derivative, right? And you know the risk of OTC derivative. So there's a benefit of dealing in or trading in the listed derivatives, right? The listed derivatives, and those listed derivatives, like maybe if the uh, issuer name or the reference entity name is listed on this iTrax MSCI ESG screened Europe index, then you could easily trade that particular derivatives, on the exchange. That would become exchange traded derivative, right? Okay. And uh, further to that, maybe uh, like maybe there are, so I already told you this could be used for hedging purpose. This could be used for buy side. This could be used for sell side, right? These are three different ways how you would be uh, you know uh, you know taking an exposure to such kind of CDS, such kind of ESG related credit derivative CDS. But that's maybe what it is, right? Uh, right. And I think maybe this is we expect over the next coming years. I heard that S&P is working on such index as well, right? So are the other, like S&P 500 companies, how to screen those 500 companies and create an index which will allow people to only take exposure to uh, companies which are very important for ESG development, like specifically for environmental and social development. Important means both ways, right? Either those companies, if they would be improving the ESG scores, then there would be you know huge impact on climate reduction on of climate risk, right? Mitigation of climate risk. Or those companies who are ramping up new biz coming venturing into new businesses, which anyway will be renewable energy focused and those kind of sustainability development focus. Those kind of companies, if those companies will grow, it will constitute those particular names which would have both positive and negative implications for the ESG, right? So such kind of indexes are going to come, and people, you will see, you will definitely see, and that's my hunch, that people are not going to trade on main index. Rather, people are eventually pick up this, and being responsible, they are going to trade on the ESG index. That's how important it is. The trading will shift to those particular names, and those particular names will become more liquid, more buy selectivity, more activity in those. And the more the liquid, even the retail participation will increase as well, right? So once the institution will generate liquidity into specific names which are maybe very important, or from a screening perspective for ESG topics, right? Other investors, like retail investors or other investors, will jump the bandwagon, right? The liquidity, once liquidity is created, then everyone try to get most out of it, right? Okay. So the third kind of derivative would be exchange traded derivative. You got a flavor in the previous slide, right? So many of the prominent exchanges, right, the like of Eurex, uh, ICE, Intercontinental Exchange, the Chicago Mercantile Exchange, NASDAQ, Chicago Board Option Exchange, CBOE, Euronext, and Japan Exchange Group. They have uh, you know come up with the equity index futures and options. In FNO space, they have come up with future and option contracts, right? Which are now listed on those particular exchanges, right? These are few of the examples, different kind of future and option contracts which are purely ESG driven or climate impact driven, right? And the one of the benefit is that they want to channelize the equity investments, right, away from very how to say, very neutral stance, that it doesn't really matter, I'm only looking at maybe the valuation or pricing, how the equity market how some companies generate return on the equity markets, to something that, okay, maybe these are some of the in FNO which allows you to invest in those particular companies or take exposure to those particular companies which are very important from a long term or medium to long term perspective for climate risk, right? The more you are investing in these companies, you are diversifying in a class called alternative asset class, which is going to very soon become the mainstream asset class, right? It is not going to stay alternative like forever. Once the, as I said, the liquidity, market liquidity will increase, it is going to capture major part of your portfolio allocation, investment portfolio allocation. And I think many of the funds, institutional investors have started taking exposure through FNO to these kind of indices, right? These kind of FNO contracts, right, which are specifically focused on ESG, right? Okay. So as well as the regulatory, like many regulatory bodies, like in India, if it is, or maybe mutual fund regulatory authority body, or any kind of insurance fund regulatory authority body, or pension fund or retirement fund or endowment fund uh, regulatory, because many of these funds which I am naming are regulated, right? They have also come out with guidelines that to what an extent the fund has to, in its various schemes, have to do allocation to this particular ESG uh, asset class, which is as of now maybe it will staggered it up, but they have not maybe taken a lot, because they know that maybe a lot of switching of investment would create also market volatility. But they have given a target and a staggered target, which a staggered plan to bump up or ramp up this investment and do more allocation to ESG asset class, right? Hence it would become a mainstream asset class in coming years, because more institutional money will flow, more liquidity will created, retail money will eventually flow there, right? Okay. And last but not the least is maybe emission trading. Now, you carbon emission trading, carbon trading, right? All these kind of things have been always called for and interchangeably used to refer to emission trading, right? Now, emission trading is, and earning carbon credits, right? Earning carbon credits or buying carbon credits, selling carbon credits, selling excess carbon credits, buying deficit, making up for the deficit carbon credits. So it's simple, right? That maybe uh, it's kind of a, that kind of derivative or market traded instruments where, you know based on geography, sector, subsector, industry, sub industry, segment, and company, right? This kind of maybe filtration, certain limits have been set, certain caps and limits have been set, right? Which are, sort of a, you know which limits on what? Limits on carbon, carbon emission, right? This particular, you know kind of an industrial concern or large industrial concern, uh, in a particular sector or industry, like maybe automobile, and maybe into ancillaries, into maybe it's a large supplier of ancillary, auto ancillary, right? Could have this limit on carbon emission, this limit on carbon emission, right? And that limit on carbon emission is not going to stay there, right? Hello, right? As per the commitments made under the international protocol on climate change and many of these regulations, year on year that limit will go down, and eventually we are moving towards zero carbon emission, but that limit will go down, in a staggered fashion. But given a limit for that year, for that year, if the company is above the limit, then it has to buy carbon credits from some other company who has carbon surplus. Like it has not even utilized its limit, it is very less polluting, right? It has maybe switched some of its manufacturing to renewable sources. So it has maybe used 60% of its limit. So 40% of its limit could be sold in the market surplus. They could gain, they could trade and sell 40% of its limit, right? Carbon emission limits into the market, and those kind of thing, the buyer of those would be those particular firms who are over polluting, who are above the limits. So this is what, in a layman terms, carbon emission trading or carbon trading, you know, how it maybe pans out, or how it mechanically happens in the market, right? So there are certain maybe metric ton, or the limits are set up in metric ton depending upon maybe ppm, right? What kind of pollution you are, air pollution, air quality index, whatever, right? aqi, right? So or dependence on fossil fuels or carbon fuels, right? So the limits are set maybe, and those particular limits need to be obeyed by most of the European companies so far, right? As well as India is, now you see that we had signed a trade pact or trade deal with the, landmark trade pact or trade will deal with European Union. So we would also be, right, eventually, and we are signatory, by the way, to IPCC or Copenhagen, right? The Paris International Protocol on Climate Change and Copenhagen International Protocol on Climate Change, we, our Prime Minister Narendra Modi has signed up and committed something that by 2020, 2030, 35, 40, we have some sustainability goals anyway. Now, we being dealing with such European Commission or European Union, it would be hardly, it would be even more stringently enforced on us, right? So we would also start seeing maybe the SEBI, the capital market regulator, right, allowing for carbon trading, right? Or maybe allowing more liquidity and more development of carbon trading in India, right? So this kind of a market allows you to deal in the primary market, right, which is generally organized by through auctions, and the secondary market, which is as on date, right? A bit of, maybe you could take exposure through the OTC, like maybe some of the right, derivative contracts, OTC derivative contracts would allow you to take exposure to this particular market in the secondary market. You can't buy or sell like you buy stocks or bonds, right, as on date, right? So that's where I said that the capital market regulator would do something to allow, such trading happenings in the secondary market. But now if you want to take exposure, you need to take a the aforementioned derivatives, or right, to take an exposure to such kind of carbon trading in the secondary market, right? Okay. And wherever we are talking about OTC transaction, you now understand that after the Lehman Brother crisis in 2010, 8 to 10 crisis, what maybe a derivative regulation, its clearing, its settlement norms, the central clearing, or maybe the requirements of margining requirements, variational margin or initial margining requirements for OTC derivative contract, many of these things have changed. So the ISDA norms, right, are very much applicable to these OTC transactions or OTC derivatives, which allows you to take exposure to such carbon trading related activity, or carbon trading related positions in the broader market, in the secondary market. So that need to follow ISDA norms. So that need to, the derivative, you need to ensure, all you need to ensure while dealing in such derivatives, that the derivatives, such derivatives or contracts are ISDA compliant. That's one angle, right? That once, as soon as they're ISDA compliant, you are confident that maybe it's safer to deal in such derivatives, because there would be margining requirements as per the ISDA norms, and there would be certain requirements which are part of the contract. Yeah. So Nitish, may I do a quick time check here?
Yes, sir. I mean, we are a little, I mean, past the time, but yeah, I mean, if you
Okay.
need like maybe few minutes, you can complete, and then we'll have the Q&A.
Some of these other aspects, maybe I would rather say that maybe I have included, I would be happy to circulate these slides, but I have included some of the modeling aspects as well, right? Which, like, how models could be made in this area. But those particular aspects we could have another follow up session, right, where we would be only be talking about the modeling aspects, how to model for such climate risk. Yeah. So from a derivative perspective, the market perspective, what kind of instruments are coming up and how the market is developing, we have covered the ground. Yeah. So I'll rather
Wonderful.
be right, giving opportunity to people because it's a new topic, right, for most of us, including myself, to ask question and to interact on this topic. Yeah.
Yeah, yeah, absolutely, absolutely. All right. So before we go to the Q&A, maybe to give Sanjay a breather as well. It was like a very, I mean, engrossing session, but again, you have been speaking non-stop. So maybe just to give you a breather and
Yeah.
also to
Thanks.
maybe quickly uh, mention the work that I at IIQF we have been doing. Just like maybe I'll take like 4 or 5 minutes time, and then we will do the Q&A. Right. So the participants, just a minute. Let me uh, make myself the presenter once again. I hope my screen is visible. Is my screen visible, Sanjay?
It is visible.
Great, great. Okay, so yeah, I mean, very quickly, most of you who have been participants in our webinar, you know about us, but just like a quick summary for what we have been doing over the first more than 1.5 decades, championing and promoting the cause of quantitative finance and finance engineering in India. So we are an educational and training body which focuses on education and training in the field of quantitative finance and financial engineering, risk management, quantitative algorithmic trading, and of course, AI-enabled applications in finance. We as a body were founded by pioneers in India and like top experts from the field of financial risk management, financial engineering, and investment banking. And our focus for the last 1.5 decade had been to promote or have been to promote the education and training in these fields, right? So for those who have a serious interest in building a career in this related areas, right? So we do have a lot of resources which you can use to build your career in this field, right? I mean, we do have very comprehensive certificate programs which builds your knowledge and credentials to work in the quant and machine learning and related areas in finance. So these are programs which are done through live, online, and instructor-led weekend sessions. So basically, people either, I mean, working professionals, or if you are a student also, full-time student, you can do it side by side and build your background and, I mean, learn the things that are necessary to make a career in this field. So very briefly, I'll go through the courses that we do, which covers different facets or the aspects of the quant industry. So if somebody wants to go into deep the mathematical modeling, we have a course called Certificate Program in Financial Engineering, which is very heavy on the mathematics and the mathematical modeling that is required for the quant industry, both the theory and the practical modeling. It's a 8 months weekend program and with some primer modules to prepare you with the basics. Uh, I mean, if somebody doesn't want to go into too heavy maths, then there's a very practical quant course we conduct. It's called Certificate Program in Quantitative Finance and Risk Management, very deep course in itself, but covered in a little less mathematical way. So, I mean, for people who doesn't want to go into too heavy mathematics and do also want to focus more on the risk management side, we have a course called Certificate Program in Quantitative Finance and Risk Management, which is again weekend, 7 months. And for those who want to specifically focus on the trading industry, quant trading, algo trading, and all those areas, right? So we do have a course called Postgraduate Program in Algorithmic Trading, which trains you in all aspects on how to build algo trading systems and how to do systematic trading using different kinds of strategies, be it your technical analysis or price action strategies, or be it your machine learning or quant model based strategies, right? Now, I mean, there are certain specific courses where we teach the data science, machine learning applications in finance. So we have a course called Certificate Program in AI for Finance, which is a very comprehensive 10 months course teaching all aspects of data science for finance, machine learning for finance, and their applications in different areas like risk management or derivative valuations or trading or generative AI in finance and all those areas. So that's like the full comprehensive 10 months course. If somebody doesn't want to do the entire 10 months course, they want to learn some specific areas, then you can do part modules as well. So, I mean, you can choose to attend only the data science for finance part, which is the first 3 months of the AI for finance course. You can do as a separate certification, certificate program in data science for finance, or you may do the second part of the course, which covers all aspects of the machine learning areas in finance, the supervised learning, unsupervised learning, deep learning, neural network, NLP. All of this in context of finance is covered in the second part of the course. If somebody wants, they want to learn only the machine learning models, they can do only or maybe join only the second part of the course. And for those who already have a strong background in machine learning and data science, they can directly go, I mean, look for this applied areas, right, in uh, I mean, different facets of machine learning applications in the finance industry. So, I mean, you can choose to specialize either in generative AI in finance, or maybe in AI for trading, or AI for risk management, AI for derivative valuations. So, I mean, these are courses of 3 months, again on the weekends. For those who have background in data science, machine learning, they can directly do these applied courses and learn the basics facets of different applied areas in the trading industry. Good news is that very shortly we are coming up with a specialized module on climate risk and ESG. So those who have an interest, keep track of our announcements in the website, as well as, of course, we will reach out to you over email and other communication mediums. So we would be having a specialized course in climate risk and ESG as well. For those who are joining the quantitative finance and risk management course, they would have that as a part of their syllabus also. And you can join that as a separate module as well. It would be a module of about maybe 2.5 months to 3 months, where we would be teaching specifically about the different aspects of climate risk and ESG. So those who are interested, you can, of course, get in touch with us. And anyway, once we announce formally in the website, you would be able to see those courses as well. Right. I mean, IIQF, as I said, we have been championing the cause of quant finance for more than 1.5 decades, and there have been thousands of professionals or students who have benefited from our courses. So for those who are interested, I mean, you can look at like our student feedback or testimonial pages, just for to understand how professionals and students actually can utilize our courses, learn the field, and enter into the quant industry. If you're already working in the relevant area, for you also, if you want to deep dive, go deep into the field, you can utilize these courses to learn and understand this field, right? So yeah, there have been many students, and then this is just like a small subset of people who have shared their kind thoughts after attending the courses and how they have benefited. So this is for your reference, so that you can understand how you can also utilize these courses, right? And as for our courses, I mean, it's not like only teaching. It is like a full-on uh, career mentoring as well, right? And then the career mentoring program starts not only during the course, but it starts as soon as you get in touch with us to understand the courses, right? So that, I mean, there are domain experts who talks to you, who speaks to you, who understand your requirement. They can suggest you the right course, the right career path basis your background, your overall education, and that starts from that. And then, of course, once you're the course, during the course also, the courses are invariably always taught by people who are working in leadership positions in the quant and machine learning and related areas in finance, right? So you'll be taught by people who are themselves using these models in the industry. They are in the forefront of the modeling world. So you not only they teach, but of course you can connect with them for career mentorship as well. So that's also another benefit that one can derive. And then once you finish the course and you are eligible for the certificate, then there's a dedicated placement support team as well who helps you in the entire process of uh, I mean, the resume building, tailoring the resume for like the particular industry in which you'll be applying, your in LinkedIn profiling, interview preparation, then helping out, you're sending your resume to the right companies basis your profile, getting you interview calls. So they help you in the entire process. And of course, our IIQF's industry association, with the strong network of alumni, we ourselves having been working in the quant industry for maybe more than 2 decades. All that definitely helps. Even the faculties, they also there are in a very senior leadership position, so they also hire a lot. So a lot of this, so we utilize all of this to help the students as well to connect with the right companies once you complete the course. And another thing that I would like to mention is, our courses, particularly the flagship programs, they are jointly, certification is jointly given by our institute, IIQF, and London Institute of Banking Finance, LIBF. Now, for those who don't know, LIBF is one of the world's oldest finance certification bodies. It was established in 1876 by King's Charter in England, right? So essentially, it's like one of the world's oldest certification bodies, and more than 1.5 million people have done their certification. So it's a great addition to the credentials for the certificate, that the certificate is jointly certified or certificate is jointly awarded by LIBF. And once you get the certificate for the programs where LIBF certification is applicable, you earn CPD credits as well. Now, CPD credits are very useful for professionals as well as students as well, because one, you can use the CPD credits in a lot of places, and more importantly, the CPD credits are approved by international regulators like OFQUAL, so it gives an additional credibility to the certifications, right? Um, Once you do the complete the courses, so the jobs that you can target would be maybe in kind of companies like, again, hedge funds like Renaissance Technologies or DES or Citadel Millennium Partners, or you can target commercial banks, JP Morgan, Citigroup, Nomura. You can target the investment banks like Goldman Sachs, Morgan Stanley, Deutsche Bank. You can target all kinds of asset management firms, be it the mutual funds or the PMS, pension funds, or the sovereign wealth funds, so on and so forth. You can, of course, target the fintech companies as well, maybe Visa, MasterCard, the Ant Group, Stripe, Bajaj Finance, to name a few. You can target financial software and product companies like Numerix, Murex, FactSet, Bloomberg, etc. All stock exchanges like NYSE, NSE, etc. Consulting firms, EY, Deloitte, PwC, and all this kind of leading consulting firms. You can target the central banks and regulators like Fed, ECB, RBI, etc. Of course, even the IT companies who do a lot of projects for the BFSI domain. So you can target MNC RT companies like Accenture, Cognizant, TCS. There's just a small list of companies which you can target. The world, this world is quite expansive, and it's like quite involved. So essentially, there are a lot of companies where the skills that you learn from our courses are very useful, right? The few kind of like roles or the teams that where you can target roles in quantitative research and analysis. You can be part of quantitative and analytical software development. You can be part of valuation teams where you deal with derivative valuation and pricing models. You can be in model validation teams. You can be in portfolio management teams. You can be in portfolio analysis teams. And of course, you can target different kinds of risk management teams: market risk, credit risk, operational risk, liquidity risk, so on and so forth. You can be part of derivative structuring teams. You can be quant trading and algo trading teams. You can be part of HFT, high frequency trading teams, and of course, other derivatives teams, right? Again, this is like a very short or a small set of companies which we have had different kinds of associations. Particularly the entire quant industry. We have worked with. It's like been a long journey. And as a part of your endeavor to promote this field in educational institutions as well, to the awareness of students, we work with a lot of educational bodies as well. We do conduct a lot of sessions, webinars, seminars, and different other kind of like again activities with educational bodies as well. So these are just like again a small set of people or educational bodies that we work with. So for example, I mean we are going to IIT Madras tomorrow itself to actually like again conduct a session on careers in financial engineering and quant trading. So we do this kind of events as well. So I mean we have been doing our bit to promote this field, and I mean I would like to think that we have been part of this quant journey in India, and again have contributed somewhat to the propagation of this field as well. Right. So for those who want to get in touch with us to for any guidance regarding this field, or even if you get interested in any of our courses, these are the contact details. You can get in touch with us. I mean, with the to the number that is provided, or you can email to us as well. We'll be happy to discuss and guide you regarding the careers, or like again the courses, or like again how you can actually enter the industry. Right. So with that, maybe. We will start with the Q&A, right? So the questions, so we do have questions, and like Sanjay, I'll collect the questions for you, and then
Yeah.
maybe we can answer the questions one by one. Okay, so let me see. Cosme, for someone new to USG derivatives, what practical factors should we focus on first when trying to understand how USG considerations are embedded into derivative products? Though you have discussed this, I mean, this was a question which Kosumi has put up even before the session started. So you have covered a lot of it during the session. So, but if you want to add anything,
Yeah.
Sanjay.
So, Koshmi, right? So,
Yes.
I'll just try to very pinpointly answer what I have covered beyond that, so that it would add value, right? So the thing is that ESG generally could be seen as a scorecard, right? You call it scorecard, you
Right.
call it model, you call it maybe a rating variables, right? Some of those could be like I could tell you straightforwardly, like maybe what part of the cost of goods sold, the input costs of a particular firm is fossil fuel dependent, right? Okay, so that could go into the scorecard, because the gross profit right after that, whatever they are earning, if that gross profit is coming out of some, high carbon footprint, maybe dependence on some fossil fuels or whatever, so that could be part of that, right? What part of logistics cost is dependent, logistics and transport cost is dependent on fossil fuels, right? uh, the other part is that maybe whether the, on a qualitative side, whether the company has some sustainability targets or not, right? Which are part of the governance and sustainability targets. Or so a variety of these. What part of the capex of the company, development capex, not the maintenance capex, development capex of the company is in projects which are less carbon footprinting, or in the on the renewable side or sustainability side. So a lot of these particular factors tie back, the balance sheet or the P&L, right? The financial performance broadly, to you know uh, telling you how you could read or screen that financial performance in terms of the ESG, right? And based on that, a particular scoring could be given, a relative score could be given, which will compare the company amongst all the companies in that particular region, industry, sector, subsector, segment, right? Segment means whether it's a large corporate, mid corporate, or small corporate. And then maybe you could then relatively assign a score, and based on that scoring, right, you could use that particular score into your derivatives, what I covered, maybe sustainability related derivatives, or maybe the credit derivatives, maybe ESG linked credit derivatives, all of that, you could use that particular score there. Yeah. Plus,
Yeah,
just
absolutely. Yeah.
one more thing to add.
Yes,
Each,
please.
irrespective of the individual, these standalone or idiosyncratic performance of the company, right? There are certain industry sector factors as well, which are part of scorecard, that even if you are less uh, pollutant company or a firm which is very conscious of sustainability, but you are employed in a sector or industry or a region which is very vulnerable, right? Like hospitality in coastal areas, right? Say hospitality in and around volcanic eruption zones, right? Or maybe high seismic zones where the earthquake possibility is high. So some of these kind of things, if you have assets concentrated, earning revenue concentration in those areas, right? From an industry perspective, also from a firm or idiosyncratic perspective, then also that would be captured as a multiple confluence of risk factors in your scorecard. Yeah.
Absolutely. I hope that answers your question, Kosumi, and I believe that has answered the few of the other questions as well. Akshay has mentioned, uh, I'm interested to know the ESG climate change, which I think we have covered, and what is ESG, that has been covered in depth. Okay, the next question is from Jigyasa, and what exactly is climate risk modeling? What attributes we have to consider for climate risk modeling? I believe that is something also we have covered in deep. Anything you want to add which we have not covered, Sanjay?
So uh, there are certain market models which are used for derivative pricing. Like there's a model called Louis Bachelier market model, which is very prominent
Right.
model, right? Uh, Now the latest research is how to extend that particular model for ESG modeling, right? So to quell your jigyasa, right? So I hope maybe if you people are interested, right, just place that requirement with Nitish, right? I don't want to do injustice with that topic, because I'm also very much excited about covering specifically on modeling, right? So we could have another session, maybe another webinar arranged somewhere in future, if many of you will provide feedback in your chats that you would like to have another session, follow-up session on that. We would be conducting that on specifically on modeling, right? And different kind of models used for sustainability and ESG modeling. Yeah.
Wonderful. All right. Uh, Next question is from Adil, and he has asked from investment perspective, what impact it will have on the mainstream equity market portfolio, medium to long, as institutional investment portfolio shifting,
Mhm.
moving their allocation towards ESG related sectors swiftly as regulation and enforcement is coming.
Yeah. So the major, lingering factor is the liquidity risk. As the
Correct.
trading volumes and liquidity and the holdings in those kind of mainstream asset classes will go down, right? Even if they are very sensitive, like even if 10% trading volume will move from there to here, right? You will see a tectonic shift, right?
Right.
Because of the reason, because already people are aware and they are getting more aware through regulation and through policy framework and through some of these international pacts which countries and transatlantic alignments are signing to. Now once they get aware, obviously that 10% or 20% would do enough to leave a dent on the trading volumes of those. And once trading volumes goes down, you see the impact on price, impact on volatility. It would be very high volatile segment, because people will take sell positions in the forward market, right? Even if they won't be selling today, they would take sell position in the FNO market or forward market, right? And the such selling position or such outstanding interest in selling position on mainstream asset classes, which are many of those names are very heavily dependent on traditional or conventional sources of energy, fossil fuels and whatever, right? Thermal power or those kind of thing, coal burnt thermal power or whatever, right? So they will maybe or eventually get a price impact, huge price impact.
Yeah, yeah, absolutely. Okay, wonderful. So, any other questions? Because most of the other questions that has come up, I mean, we have covered during the session as well as like while discussing the other questions. Any other question that is coming? Otherwise, actually, like again, we have covered most of the stuff. So yeah, I mean, anybody having any other question? All right. If not, then actually, I think it's time to wrap up the session. First and foremost, thanks to all the participants once again for taking your time out and joining this session on a weekend Saturday. So very glad to have you with us, and I hope you found the session to be useful. And most importantly, thanks to Sanjay, it was like a very I mean deep discussion. Given the time, I mean we covered like again, a lot of stuff actually, and I think I'm hoping the participants found this useful. Thank you so much, Sanjay.
Thanks a lot. Thanks to everyone for your active participation, and we keep keep that momentum and spirit alive, right? Because things are changing, and hope maybe we should all get on the same bus, not on different bus, and that bus is run with the some renewable energy, right? Thanks.
Absolutely. So the Kunal has said that eye-opening session, very informative session. Thanks so much, Kunal. It is very heartening to know that you found the session informative. This is conducted for you all. So I mean, we always uh, are very happy to when actually I mean you find it useful, right? So with that, we'll close the session for today. But as you all know, and for those who are new, we conduct regular sessions. I mean every month, once or twice, on important topics related to our area of financial engineering, quant finance, risk management, uh, algo trading, quant trading, uh, ML and data science applications in finance. So, I mean, and we have this regular series called Deep Dives with IIQF experts, where experts like Sanjay come and like again talk on the various important aspects, right? So please do keep track of our website, our social media pages, and our other pages, right? So we would also intimate all of you regarding the upcoming webinars. I mean, in fact, we do have another session coming up on the 14th of this month itself, right? Again, please feel free to join that, register and join that session. It's also a very important session that we have, right? Okay. So with that, I'll end the session here. See you again in the next sessions. Look forward to having you again. Thank you.